If you've been anywhere near the metals market today, you felt it. Silver just ripped nearly 9% higher in a single session, clawing its way back toward roughly $86 an ounce. And it did it only days after one of the nastiest collapses modern traders have ever witnessed. I'm talking about a 27% wipeout in hours, followed by another hard drop. Blink and billions vanished. So what is this move? Relief bounce? Or the opening act of something bigger? Stay with me, because I'm going to show you exactly what just happened, why it matters right now, and more importantly, how you can recognize this pattern the next time markets go nonlinear. If you're holding silver right now, if you're watching from the sidelines trying to make sense of this, or if you just want to understand how markets actually work when they break, you're in the right place. Now, before I explain what caused this surge, let me teach you something most investors don't fully grasp. Markets don't just move on fundamentals, they move on positioning. Think of a crowded theater where everyone suddenly smells smoke. It doesn't matter if there's actually a fire yet. What matters is that everyone tries to exit through the same door at once. Prices don't fall politely in that environment. They gap, they cascade, they overshoot. And here's what you need to know about the term oversold. It doesn't simply mean cheap. It means forced selling has exhausted itself. There's a difference. When traders are liquidated, they aren't making thoughtful decisions about value. They're reacting to margin calls, risk limits, and survival. So when that pressure finally lifts, even slightly, prices can snap back violently. That snapback you're seeing today? It's the market inhaling after nearly suffocating. The violence works both ways. And if you understand this concept, you're already ahead of 90% of people watching price action without context. If this is making sense so far, drop a comment below and let me know you're following along. So what's actually happening under the hood right now? Let me walk you through the mechanics. Last week's crash wasn't just fear, it was mechanical. Futures exchanges raised margin requirements, which is basically the market saying, you need more cash to hold this trade. Suddenly, leverage players had to either wire money immediately or dump positions. And here's the thing about leverage. Most people dump. They don't have spare capital sitting around waiting for a margin call. So when silver started falling, that triggered liquidations. Those liquidations triggered more selling. More selling forced funds to de-risk across their entire portfolios. It's a chain reaction, like dominoes laid too close together. Each fall creates the next. You get this cascading effect where the selling feeds on itself and price discovery breaks down completely. That's what happened, and you could see it if you knew where to look. Secondary confirmation came from volume spikes and widening spreads. That tells you this wasn't orderly profit taking, it was stress. When liquidity disappears, when market makers step back because they can't manage the risk, prices exaggerate in both directions. The bid-ask spread blows out. You see gaps between where someone's willing to buy and where someone's willing to sell. That's dysfunction. That's what happens when the machinery of the market itself starts breaking. And volume? Massive. Because forced selling doesn't trickle out over days. It hits all at once. Everyone's trying to get through that same exit door I mentioned earlier. Now here's the convergence, and this is where it gets interesting. Today's surge wasn't driven by euphoric new buyers chasing a story. It wasn't driven by some fresh fundamental catalyst that suddenly made silver more valuable overnight. It was driven by the absence of forced sellers and aggressive dip buyers stepping into what suddenly looked like a clearance sale. When the selling pressure from liquidations finally exhausted itself, when the last over-leveraged position got flushed out, there was nobody left pushing price down. And that's when buyers who'd been waiting on the sidelines saw their opportunity. They stepped in, hard. And with most of the sellers already out, there wasn't much resistance on the way back up. That creates the mirror image of the crash. Violent move down, violent move back up. Same mechanics, opposite direction. But here's the part that should make you nervous, and I want you to really hear this. Reflex rallies after liquidation events are common. Durable bottoms are not. Just because something bounces doesn't mean it's done falling. Markets love to lure participants back in before testing lows again. You've seen that movie before, right? Let me show you the pattern. Because this isn't new. This is the exact same playbook markets have run through before. Think back to the 2020 pandemic panic. Gold and silver both plunged initially as investors sold whatever they could to raise cash. Didn't matter if it was a safe haven, didn't matter if fundamentals were solid. When liquidity dries up, everything gets sold. Then came the rebound once liquidity stabilized, once central banks stepped in, once the forced selling stopped. Silver went from under $12 to nearly $30 in months. Same pattern. Liquidation, exhaustion, reversal. Or look at the 2008 financial crisis. Even safe haven assets dropped during peak deleveraging. Gold fell from over $1,000 to under $700 in months. Why? Because hedge funds and institutions were selling everything that wasn't nailed down to meet redemptions and margin calls. But once that wave passed, once the selling exhausted itself, gold rallied from those lows all the way past 1900 over the next few years. Massive recovery, because the selling was technical, not fundamental. The world didn't stop needing gold. Traders just needed to raise cash. Zoom out and you see the larger story. The most violent down moves often plant the seeds for equally dramatic upside, but only if the selling was technical rather than fundamental. If the asset itself is broken, if the story is over, you don't get these rebounds. You get slow grinding declines. But when it's positioning that breaks, when it's leverage and forced selling, that reverses once the pressure lifts. And that's the question hanging over this rally right now. Was the selling technical or fundamental? Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a dead cat bounce? Absolutely. Could we retest the lows? Yes. Could this rally fail and roll over again if macro risk spikes? Of course. And here's the thing about manipulation claims you might hear floating around. Blaming shadowy forces is emotionally satisfying but rarely actionable. Does manipulation exist in markets? Probably. Can you trade based on that assumption? Not really. Focus instead on observable signals. Liquidity conditions, leverage, positioning. Those are measurable. Those give you an edge. Conspiracy theories don't. Could silver roll over again? Sure. But if the forced liquidation phase is truly behind us, the character of the market should begin to change. You should see shallower pullbacks, stronger support, steadier flows. And if you don't see that, if the volatility stays extreme, that tells you something too. There are probably three types of people watching this right now. First, you might be the investor who panic sold into the drop. Maybe you held silver or silver miners, watched the collapse happen, felt that pit in your stomach, and hit the sell button somewhere near the lows. If that's you, don't beat yourself up. Extreme volatility is designed to shake people out. It's designed to trigger emotional decisions. Your job now isn't regret, it's observation. Does this rally hold? Do buyers defend dips? Are you seeing structure return to the market? Watch and learn. That experience, as painful as it was, just taught you something about yourself and about markets. Use it. Second, maybe you're the sideline watcher who felt frozen while prices crashed. You wanted to buy the dip, but couldn't pull the trigger because the violence was too intense. Totally normal. Most people freeze when things move that fast. The lesson here is preparation. When markets get disorderly, having predefined entry zones keeps emotion from hijacking your decisions. If you know in advance, I'm buying if silver hits 80, then you can act. Without that plan, you'll freeze every time. So take this as your cue. Build your playbook now before the next event. Third, you could be the disciplined trader who recognizes liquidation footprints. Maybe you've been through cycles before. Maybe you understand that panic creates opportunity. If so, patience is still your advantage here. The best reversals usually retest. They usually give you another chance. Let the market prove stability before assuming trend. Don't chase violence just because it's moving in your favor now. The universal principle, and this applies to everyone regardless of where you stand, is this. Don't chase violence. Understand it. Because once you understand the mechanics, you can anticipate instead of react. So here's what I want you to answer in the comments. Where are you in this? Did you sell into the panic? Did you freeze on the sidelines? Or did you buy the dip? I'm genuinely curious, and honestly, there's no wrong answer here. Each position teaches you something different about yourself as an investor. Here's where I stand personally. I'm not calling this a new bull leg yet, and I'm not dismissing it either. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether volatility compresses. If chaos cools into structure, if we start seeing orderly moves instead of these wild swings, that's constructive. That tells you the market's finding equilibrium again. Second, I'm watching futures positioning to see if leverage rebuilds. And critically, I'm watching how it rebuilds. Is it responsible? Are traders scaling in carefully? Or is it reckless, with leverage ramping back up to dangerous levels? Because if it's the latter, we're just setting up for another liquidation event down the road. Third, I'm watching follow-through. One explosive day is noise. It's interesting, but it's not a signal by itself. Sustained demand over days and weeks, that's signal. That tells you buyers are committed, not just opportunistic. What I'm not doing is making assumptions about where silver's headed next week or next month. I don't have a crystal ball, and neither does anyone else. What I do have is a framework for understanding what I'm seeing. And based on my analysis, this crash and this rebound were mechanical, not random. The fundamentals didn't implode overnight. Silver didn't suddenly become worthless. What broke was positioning. What broke was the over-leveraged structure that had built up in the derivatives market. And when that structure collapsed, it took price with it. But the underlying fundamentals, the reasons people hold silver in the first place, those haven't changed. Industrial demand hasn't disappeared. Monetary concerns haven't vanished. Supply constraints haven't resolved themselves. None of that changed during this volatility. What changed was who owned silver and how they owned it. And if history even slightly rhymes, episodes like this don't just mark stress. They often mark transition. They shake out the weak hands. They reset positioning. They create the conditions for the next move. I'm not saying that move is guaranteed to be up. I'm saying these liquidation events clear the deck. They create opportunity for those who understand what just happened. Now, I'm not a financial advisor. This is not financial advice. You need to do your own research and make your own decisions based on your own situation and risk tolerance. What I'm giving you here is education. I'm showing you how to watch markets, how to read price action, how to separate mechanical moves from fundamental shifts. That's a skill, and if you develop that skill, it'll serve you across every market you ever trade or invest in. If you made it this far, you're exactly the kind of person who's going to navigate this environment successfully. You're not looking for hype. You're not chasing guarantees. You're building understanding. That mentality will serve you well, not just in silver, but in everything that's coming. Because let me tell you, markets are entering a phase where volatility isn't the exception anymore. It's the baseline. And the investors who thrive are the ones who understand mechanics, who stay calm when others panic, who see opportunity where others see only danger. So do me a favor. If this breakdown helped you understand what just happened, hit that subscribe button. Share this with someone who's trying to make sense of these moves. And stay sharp out there. Think critically. Verify what you're seeing. Don't just accept the narrative. Dig into the mechanics. Because the investors who understand these patterns aren't reacting to markets. They're anticipating them. And that's where you want to be. Stay sharp out there.